Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a special market update for the month that was May 2026. Over the past few weeks, I've made time to review the real current state of the market, the history of property in Australia over the last 55 years, boom, bust, recovery, and what we should do going forward. And if you are a long-term investor, the fear-mongering isn't really going to slow you down, okay? But we all need reassurance. And I believe that 4 different forces are converging simultaneously at the moment. None of them is reversing in the short or medium term. And the 5th force, which is market fear and low consumer confidence, is creating a window of opportunity that won't stay open for long. When one works with investments and buyer psychology, one becomes all too familiar with the Goldilocks dilemma. Now, I'm not here to discuss why a young girl is breaking into people's houses, destroying furniture, stealing food, all with the intention of becoming a squatter. I'm actually talking more specifically about investors striving to find the perfect environment to enter. I can tell you, when looking at the Australian property market over the last 55 years, there have been some perfect moments. But this all comes with hindsight, and this also comes when you miss those moments. And the decision you have to make is, I missed that moment, will I miss the next one? These moments are always, or almost always, disguised as a crisis. And this chart shows real inflation-adjusted home prices. So not nominal prices. In periods of high inflation, nominal prices may have actually risen while real returns were actually negative. So this gives you the actual number, what you would really see taking that into account. So in 55 years, through oil crises, recessions, double-digit interest rate environments, a global financial crisis, a pandemic, and now the fastest rate hike cycle on record, Australia's property has recovered every single time and has gone on to reach new highs basically every single time, with an average time period of about 2 years. Okay? Let's take away all the good stuff that's on this chart so you can see this. And I'm actually going to create an interactive version of this chart for everyone to review and play around with a little bit later. It will be up on our website within the next week or so. But this shows you 55 years. You can pause this and have a little bit more of a look at it if you like. But let's eliminate all the good stuff here, all the times where people would be like, oh, I wish I was in there then. Let's focus and shorten the data a little bit, and let's look at the last 40 years. Let's see how across Australia's combined capital city housing market, how has it navigated the last 10 downturns where home values fell over at least a 3-month period. That constitutes as a downturn, okay? So it has to be 3 months and more. So in 8 out of 10 of these downturns, the calendar year in which the market bottomed still ended with prices either flat or positive. And that was due to strong first and second half framing effects. Now, you'll probably remember this from 2020 when COVID happened. It was March, and basically up until around September, the market was not looking very good. And by the end of the year, the market propped itself back up again. Why? I think people become immune to fear-mongering, negativity, and just seeing all these bad things in the media. And after a little while, they become desensitized and they just get along with life. Importantly, about what I'm talking about, the media, they amplify fears because fears generate clicks. And that fear has consistently caused investors to sit on the sidelines at exactly the wrong moment. Let's look at a few of these. And obviously, I have literally hundreds of these headlines, but let's just stick to a few of them. COVID-19, 2020. The University of Melbourne, Capital Economics, and multiple banks forecast a 20 to 30% fall in the market. The Guardian ran the headline, instead, 2021 saw the fastest price growth in 50 years. And that's nationally over 20%. So for 2020, you can see that on here. The Guardian ran this headline. I'll just move this out of the way quickly. So property crash of 20% to 30% forecast, disturbing outlook. Okay. Then we got rate rises in 2022. And what did we see there? We saw ANZ came out with the headline. ANZ predicts 20% crash by the end of 2023. Okay. Now, AMP's Shane Oliver was the one that actually said that. CBA actually publicly abandoned its 50% crash forecast afterwards, which is quite interesting because the actual correction was 9.1%. And by March 2023, prices were actually rising again. Then you've got the mortgage cliff, 2023. The narrative was waves of forced sellers will flood the market. Instead, what happened? The market continued to defy expectation. The GFC, 2008 to 2009. Australia avoided recession while the rest of the world crashed. And that was honestly because of our hero, which was Western Australia, Perth, protecting us with the natural resources sector. The property market corrected. It was down 2.2%. Then the national median price point rose by 12.1% in the following 12 months. Recession, 1990 to 1991. Australia's worst downturn since the Great Depression. Properties rose in most markets. So the pattern here is that property in Australia has an extraordinary record of rebounding, and the forces that support it, so chronic undersupply, population growth, land scarcity, lending standards, are more powerful than the forces that periodically scare buyers away. So this is another reason why I've got a lot of hope. Some more data here. This is me taking away even more of that noise in regards to downturns and economic events nationally and globally. And what you'll see at the bottom here is I've basically highlighted my top 14 international and national events that affected Australian property. And you can see those going across that line graph there. And you can see the downturns are in that red little mist that's standing behind there. Look at what Australia property has done. Does it look like, if I looked at some of these things, negative gearing being removed in 1985, oh no, the recession in 1990, capital gains tax discount increased and it being now 50% in 1999, up 7.5%. Like all of these things, again, if you focus on the news and the events, you'll never see this. And if we look at what's currently happening in the media, it seems like the current news cycle has turned the fear dial up to 10. Does this scare me? No. Why? Because I've seen it time and time again. And at this point, the probability is that these guys are going to keep being wrong. And when we look back at the best times to buy into the property market, there are only a few of these. And like I said before, they're usually disguised as crises. We believe we're about to see a rare opportunity where buyers have the strongest negotiation power that they've had in years. The ironic thing here is that I'm often talking to clients that will say to me, market's too hot, I'm waiting for it to cool down. You're finally in a stage where the market has cooled down. All those people that were telling me I want to jump in, I've called them over the last couple of weeks. I can tell you, except for 2 of them, out of the dozens of people I've spoken to, all of those people are still waiting. It's never going to be a perfect time, ever. Okay, let's now just quickly look at our local markets here across the major capital cities, and let's look at some data. So the expected housing downturn is now showing clearly across major house price indices. And in May, the signal was broadly consistent. So prices softened with Sydney appearing to lead the decline. The first sign of weaknesses are most visible in cities' premium markets, your really expensive suburbs. And that's where the higher interest rates and weaker sentiment are weighing heavily on expensive homes. But this may only be the first stage, because as investors start to pull back, pressure is likely to build in the much cheaper markets that are more investment exposed. I'm talking about our regional, rural areas Providence never buys in. But if you see those areas, year-on-year falls could ultimately be much larger for those areas. And they typically have been. Prior to COVID, no one was buying in Albury, Wodonga or anything like that. That was not happening. But since COVID, people have thought it's a new gold rush. And that's why it's so dangerous, because the fundamentals of population growth, infrastructure spend, they haven't changed. So my mind goes to some of those regional areas, and I'm honestly worried for a lot of clients that not clients of ours, but a lot of people that purchase, a lot of investors, I'm worried for them. Now, the slowdown had already begun before the May data was actually released, and that's really important. A lot of people are like, oh, this budget screwed everything. I'm not a fan of the budget. If you watch my last video, I was pretty upset. But what I'm saying is the data was already coming in for this slowdown. Annual price growth at the time was still strong at the start of the year, but the momentum was clearly shifting. And by early 2026, it had become apparent that interest rates were likely to rise again. Everyone knew it was coming. And that was changing buyer expectations and also reducing borrowing capacities. This was followed by the conflict in the Middle East, which obviously pushed consumer sentiment into its lowest level ever recorded in Australian history. The Strait of Hormuz, everything like that, slowing things down, the cost of living increasing, petrol, etc. So by early May, 3 interest rate rises had been delivered. Together, these factors turned what had been a very strong housing market into one that was far more vulnerable to a pullback. And now the icing on the cake has obviously been this budget, which has just created even more uncertainty. Let's now explore 4 compounding forces creating an enduring supply and demand imbalance. And that's what it's all about here. Throw away all the other data points, all the other information that you get, all your podcasts, all that type of stuff, even what you listen to me say. Just focus on supply and demand, okay? And I want to figure out why market fear is going to create an amazing buying opportunity. So let's go through those numbers together. So here we can see consumer sentiment is at 80.6. This is a market gripped by fear. That fear is your best opportunity if you are someone that's in a position to buy. 262,000 dwellings is our shortfall. So this government's own modeling has actually said, nope, we're actually going to have a shortfall over 250,000. So not a property industry number. This is the government. 1.7% vacancy rate. So the pre-COVID decade average was 3.3. And we're running at half that historical normal. In Perth, it's actually 0.6%. So it's even more destructive for those markets because rents are just going to keep pushing up. 74% construction costs increase. So every new dwelling being built today costs 74% more than in 2019. And this puts a permanent floor under existing property values. Not surprisingly, capital city home forecasts have been downgraded across the board with the most recent update. I think it was ANZ forecasting about 2.8% up only in 2026. That was downgraded from their 4.8% increase that they had prior to that. I think they brought that in February, and they obviously downgraded that after the May budget. So that they're looking at about a 2.1% increase in 2027, but I think it's way too early to call that stuff. But small falls are expected in Sydney, about 1%, something like that. Melbourne, about 2%, a bit stronger, but slowing. Still getting some growth in Brisbane, Perth, Adelaide, and Darwin. More, pronounced slowdown later in 2026, early 2027. That's the forecast. But again, I don't live and die by forecasts. They're just a bunch of nerds putting together some numbers, and at the end of the day, things change all the time. Now, let's look at pillar number 1 here. Okay, so pillar number 1 is supply deficit. This is the foundation of my entire case here. So everything else basically amplifies this underlying fact that Australia is not building enough homes. And everyone knows this. It's not a secret. So the 262,000 shortfall figure is from the government's own National Housing Supply and Affordability Council. So this is not industry spin, right? This is not me fear-mongering people. You should be buying investment properties. I'm just telling you, they're not making enough of it. If I told you the same thing about gold or some type of natural resource that they're running out of it, or Bitcoin or something like that, you'd go, well, this makes sense. If I buy it because they're not building any more of this, or it's really difficult for them to get this, I'm going to go out there and purchase some to get some value. The Housing Accord target that the Albanese government basically won the election on was 1.2 million homes over a 5-year period. And that requires about 240,000 properties to be built per year. In year 1, we completed 174. Which is a 27.5% miss on that target for the first year, for Christ's sake. We couldn't even come out of the gate hot. We just came out like a sloth. AMP's Shane Oliver put the cumulative deficit at 200 to 300,000 dwellings right now. And the chart that you can see right here, this little bar graph, that shows the annual gap in is narrowing slightly, but it's still a substantial negative. And crucially, it's unmet demand, and that doesn't actually disappear. It just keeps accumulating. It's going to get more and more. So why supply actually can't keep up quickly is because construction costs are too high for apartment projects to be viable. Why do I say apartment projects specifically? Because you can get one block of land and you can build an apartment complex with 50 apartments on it, and that's going to house a lot more people. But if you have that same block of land and you put a couple houses on there, you could only house a fraction. So higher density product is obviously going to be more attractive to the government because you can put more people in it, solve our issues faster. The problem is the cost of units now to build is more expensive than the cost of houses. Planning approvals remain at record lows. Labour shortage persists across all key trades. And if you've tried to get a tradesman out to do anything in the last couple of years, you can see why they're all driving Lamborghinis and Ferraris. They cost you an arm and a leg and they don't care when they show up. Building approvals fell 10.5% just in March this year. Now, closely related to building fewer houses is Pillar 2, which is the cost of building. So how is the cost of building being affected? So build costs composition from the Australian Bureau of Statistics show that materials are about 40% of the cost, labour is about 35% of the cost, and you've got your margin, your overhead about 15%, and then permits are about 10%. Now, the key material escalations here is that copper has increased by 16.5% year on year. So electrical scope driving project costs have gone up. Cement is up 5.2%, PVC and piping up 37%. And then obviously with things like the Middle East and the fuel crisis, that affects not only the raw materials being brought here, but then also any type of logistics in Australia also end up costing people a lot more as well. So that pushes pricing up. Carpentry, electrician rates, they're up 12 to 18% from what they were in 2023. And that's from enterprise agreements. The construction wages, they're up 3.4% annually. So that's the union's targeting about 4+% per annum. And steel up 4.6%. So that's partially been offset a little bit there. Now the RLB in 2026 by city actually came out and showed that Townsville prices for construction are up 6% just this year, and we're only halfway through. Perth up 5.3%, Adelaide up 5.1%, Brisbane up 5%, Melbourne and Sydney up 4%, and Canberra up 3.75%. So the cost of building is insane. Now, here's the more insane number. Tax, let's take Sydney as an example, and I've got the numbers for all the states, all the capitals, but let's just focus on one. Tax in Sydney, 49% of the new home cost goes to the government. Brisbane government share over 106% is up over 106% since 2019, and that's removing GST, and that saves about 50k. Removing stamp duty, it saves about 55k. So the interesting thing about this is that for nearly every single major capital city, out of the average new build cost in each capital city, well over 40% of that cost goes directly back to the Australian government. Okay, let's have a look here now. We're going to focus on a bit more on the construction costs. So construction costs don't just affect new builds. And this is the thing. People are like, oh, it's just going to affect the new builds. They're just going to go up. It actually creates a floor under all existing property. So the main things I want you to focus on here is that the average cost of building a dwelling in Australia has risen by 74% since 2019. 74%. Building a house costs 47% more than before the pandemic, and that's from Cotality. Apartment/unit buildings they've risen 90%, okay? And this is why there are fewer apartment projects that are actually viable, so that makes sense. So less developers are seeing apartment projects and saying, yeah, I'll build that. And some people say, that's fantastic. I don't like apartments anyway. Not in my suburb. I want to keep it all houses. I'm sorry, but if the government keeps bringing in people, you're just going to have to figure out what you're going to do and create more high-dense product. So the RLB actually forecasts a further 4 to 6% cost escalation in 2026. So they're like, this isn't slowing down. It's going to keep going. The feasibility trap. I want you to understand this. When it was built at a lower cost, right, the product itself, it becomes relatively more attractive and it retains its value. So when things cost more to build, let's say a new unit costs more to build than the market will actually pay for it, the developer doesn't build it. Okay, so when it costs more than what someone's actually going to pay for it, it just doesn't get built. And if the project doesn't get built or they don't proceed with the project, supply stays constrained, and existing properties, which, you know, become more, there's less of them, it just becomes more expensive. So this is structural, it's not cyclical. And these costs are baked into labor agreements, material supply chains, and energy inputs. They won't reverse quickly because if it's not viable, they're just not going to do it. Okay? Construction costs continued here. I just want to finish up on this part for the construction costs. So the table on the right illustrates the increase in the average dwelling building costs by type since 2019. So you can see in red is apartment and unit types, and green is detached housing. Okay, so you can see the significant increase since 2019. Detached houses have gone from costing about $339,000 to $550,000. I'm just talking about the material costs. Okay, unit and apartments have gone from $320,000 to $608,000. So this is what I'm saying. It's now $608,000 to build a unit versus $550,000 to build a house. So this explains why, again, you're just not going to see as many units when we're in a time now where we actually need them. Cotality has accelerating their CCI to 3.7% annually by February 2026, which was already passed. Oxford Economics basically came out saying that the higher costs of a new build appear like they're here to stay. So they're not going anywhere. And for us, makes a lot more sense. Okay, let's now talk about pillar 3, which is vacancy rates. The vacancy rate is the most immediate, visible symptom of the supply crisis. So it's what Aussies feel when they're trying to find a rental property because they show up and there's 50 people there. I want you to look at this. Now, 1.7% nationally is our current vacancy rate. That's versus a pre-COVID decade average of 3.3. So we're running at half the historical norm at the moment, okay? Perth is at 0.6%, as I mentioned before, and properties are rented within 24 to 48 hours of them being listed, with 20 plus applications per listing is kind of the standard. Rental listings are 17% below their 5-year average. So this is not a seasonal dip. This is a 5-year average. Australian rents have surged dramatically since COVID, with the national median rents rising approximately 40 to 43% cumulatively from late 2020 to mid 2026. I'll say again, 40 to 43% increase that we've already seen during COVID. Australian rents rose 5.2% over just the year of 2025. That's 1.5 times the rate of inflation, by the way, okay? National median rent is now $681 per week. Now, can we learn from the past? Absolutely. If we take you back in time quickly to these articles from the 14th of March 1987 in the Sydney Morning Herald, they ran a front page article titled "Sydney's Rents Hit the Roof." Now, the article states that rents increased by 25% in just 12 months. The other article, titled "PM Rents Too High, Negative Gearing Ban Faces Review," is because when negative gearing was announced in 1985 to be stripped away, the first year when it had a full 12 months to basically be in effect, which was 1986, rents increased by nearly 25%. Why? Because if you are punishing investors like myself, like you, to buy investment properties, I stop buying investments, but every investment that I buy is a home for a rental family. If I stop buying those homes for rental families to live in, where are they going to live? It just means more competition to a smaller market of options, which means higher rents for everybody who is a renter. So when people are scared or uncertain of the economy, they tend to procrastinate. And just like Goldilocks, unable to find a porridge that's just right, renters who would have graduated to being owner-occupiers continue to rent. And this adds to the pressure in an already undersupplied market and therefore results in higher rents paid to landlords. Now, if we quickly look at a chart from SQM specifically, which is one of Australia's largest research companies and specialising in vacancy, Australia's housing shortage isn't easing anytime soon. With vacancy rates stuck near 1%, demand continues to outstrip supply, making now a compelling time for us to look at potential opportunities in the market. And you can see there 1.2% in May, and the average over the last 20 years is 2.7. Now let's look at pillar 4, which is migration. Migration is the demand engine that doesn't really slow down in this market. Could we shut it off? Absolutely. Is the government going to do that? I don't think so. Why? It wins them votes, okay? And it also artificially inflates a lot of our numbers to make Australia look like we're doing a lot better than what we probably are. So regardless of interest rate sentiment or policy changes or anything like that, migration's the main engine. So the key things I want you to look at here: 306,000 net overseas migrants in 2024-2025. That's the third highest annual intake on record, and it's described as moderating. So in the 3 financial years to 2025, Australia received 1.27 million net migrants. This is the highest 3-year run ever recorded in Australian history. And then let's just quickly celebrate the government screwing everyone with that. Yay! Okay, so Australia is gaining a new resident every 75 seconds. That's 5,900 new people every single week. 73% of all population growth is from migration. The natural increase in Australia only accounts for around 27%. That is sad. New arrivals enter the rental market immediately. So people like, oh, how's overseas migration going to put pressure on rents? Well, when people get here, they don't just buy a house. First of all, you need citizenship, or you need to get your residency first, and then you've got to save some money, you've got to work here, you pay tax on that, and then after you've saved your money, that's when you buy a property. Most people don't just come here with suitcases full of cash. It doesn't happen like that. So new arrivals enter the rental market as soon as they get here, and at the same time too, they're not getting to Sydney International Airport and saying, all right, let's get the kids on a bus right now or on a train and let's go regional. Let's go Toowoomba. Let's go somewhere. Let's go further out. That's not what's happening. They're focusing on the major capital cities because that's where the majority of the jobs are. So they rent for months, sometimes years, and they compete directly with existing renters from the same severely undersupplied stock. So Treasury forecasts net overseas migration of 260,000 to 300,000 plus in 2025-2026. Even at these moderated levels, migration is running at more than 3 times the post-war historical average of 90,000 people per year. So the numbers are pretty simple with this when you actually have a look at it. The housing shortage isn't abstract. It's real basic arithmetic. So in 2024 or 2025, net overseas migration was 306,000 people, and that generated demand for approximately 133,000 new households because they divide it by 2.3 people per household. Yet nationally, we only completed around 174,000 dwellings. So that leaves almost zero margin for natural population growth. So people changing household needs, or addressing the backlog, explaining the persistent tightness in the rental and sales market. The numbers are right there. You can see it. And that is very important information for us to understand when it comes to supply and demand. So I want consumer to look at consumer confidence right now and how this is a buying opportunity for investors with long-term outlooks. Again, yes, there's going to be maybe some short-term volatility, but I'm just telling you, if you are negotiating with someone now to buy a property, there's never been a better time. There really hasn't. And I want you to look at this. So Westpac Melbourne Institute Consumer Sentiment Index, that fell to 80.6% in June 2026. The long-run average since 1974 is 100.2. That's the typical score. So we're at 80.6 in June. We're 20% below the norm. So the time to buy a dwelling, sub-index, hitting 82.9% in March 2026, right? It's well below its long run average of 120. That's the long average, is 120. So 2/3 of consumers now expect mortgage rates to rise further in 2026. Fear is at or near its peak. What does low confidence actually mean for smart buyers? Well, it means that there's going to be fewer competitors. Vendors are going to be more willing to negotiate. Longer days on market for a lot of product. And in many markets, buyers have the upper hand for the first time in years. It's what so many people have been complaining about and waiting for. But at the same time, you're going to see so many of those people sit on the sidelines and not buy. They'll kick themselves in a year's time, but I'm just saying right now they feel like they're making the right decision. So the window is closing. Sentiment always reverts towards the mean. And when it does, buyers who were sitting on the sidelines, re-entering, simultaneously, and competition ratchets up. That's just what's going to happen. So prices will respond, and the negotiating window is going to close. And the question is whether you want to be positioned before or after it happens. And we have a saying at Providence where when the market's hot, we tell people you've got to be willing to pay tomorrow's price today if you want to get this property. That's when the market's hot. When it's not hot, you want to make sure that you are in the game while everyone else is sitting on the sidelines. So I just want to make a critical distinction here. Low confidence does not actually equal low fundamentals. That's a really important thing to understand. And the supply deficit, vacancy rates, migration, construction costs, they're all unchanged. All right, everything I've been showing you is unchanged. So what has changed is the sentiment. And sentiment, by definition, reverts. So that's really important when it comes to this. One of the last things I want to talk about is the renter trap. So this is looking at basically what's going to happen with the rental market. So a buyer hesitates. Let's just start from this red box here on the left. Let me just move this out of your way. Okay, so a buyer hesitates and stays renting. They join the rental pool, which is already critically undersupplied. Vacancies fall even further. Rents then rise. The landlord benefits, and property becomes more attractive to investors. Okay, that's kind of the process. So the migration multiplier, like I said, 306,000 net arrivals divided by 2.3 persons per household, 133,000 new households. We're not making enough. This is structural, relentless demand. And the cost of waiting at $680 per week, a renter is paying $35,412 per year. So over 3 years of hesitation, that's over $106,000 in rent with zero equity, zero capital growth, zero tax benefit. Meanwhile, a property purchase in 2026, even in a flat market, would likely have appreciated and it's been paid down by rent from the tenant and provided a tax benefit. So the people who hesitate are building the investment case for the people who actually act. That's how it works. Now, I'm just going to leave you with the main 7 points here that I wanted you to take away. So history is very clear. Property crashes are driven by oversupply and demand shocks, not undersupply. So we have a severe undersupply issue here. I can't see our market crashing. It doesn't make any sense. The fundamentals aren't there. So with Australia's chronic housing shortage, record low vacancies around 1.2%, rents up 40% since COVID, and more pressure on them now, the fundamentals, they just remain solidly supportive for well-located investment property. So if you can find something good in a good location, it's going to be like gold. Grab it. Okay, let's look at these 7 reasons. Supply deficit, like I said, 200 to 300,000 dwellings of cumulative undersupply. That's the government's own data. Vacancy rate, 1.7% nationally, less than half the normal level. And this is converting renters into buyers and sustaining demand even under rate pressures. So people are going, it's going to be better for me to just buy instead of holding. Construction costs up 74% since 2019, creating a permanent floor under the value of existing property. New supply is structurally constrained. Migration, 306,000 new people. As I said, that's a number that we just can't continue to manage. Consumer confidence at cycle lows. Buyers have negotiation power now, and that's what we're taking advantage of. History, again, just seeing what happened during COVID, the GFC, when they took away negative gearing last time. We know what typically happens with this market, so we have that to help back us up. The changing of negative gearing, again, rents rose 22 to 33%, and the year when they announced that they were going to reinstate negative gearing, we had the biggest boom in Australian property history for that year in prices. So that's all I wanted to really go through. I know that's a lot today, and I really appreciate you if you've been able to stay with me for this long, because even I feel like this is a lot, but I'm telling you, this data, these fundamentals, they haven't changed. So make sure you take advantage of your understanding of the market, and if you have the opportunity to get out there and buy something, in 5 years' time, you're going to realize it's the best decision you ever made. Thank you so much for your time today. Have a great day, and we'll speak soon.